Hello, my name is Scott Forehand. Today is the 28th day of August. This is our, excuse me, I'm a little sick right this minute. Came back from Denver with COVID. What we're going to do today, this is our normal slot where we go over infinite banking and debt-free life programs. And what I'm going to do today is I'm going to show you some using real data from the stock market, from the historical stock market. I'm going to show you what it looks like to invest in an infinite bank versus investing just in the stock market and equity positions associated with the S&P, or even, for example, just buying an S&P 500 ETF that's available out there. I think they're the SPDR is the ticker symbol for that. So let me go ahead and start this. Actually, let's talk through it first. So when you're looking at putting money into an investment strategy, whether it's in a standard equity position like buying a stock, or looking at a money market, or looking at an S&P focused investment strategy, whether it's in a standard IRA or a self-directed IRA, or maybe even like a 401k where you've got some ability to maneuver within the 401k. What the thing that people look at and focus on is what the S&P growth is. And there's a couple of things that people need to understand. And this is kind of going back to what Ted Brenna did in the 1970s when the market was better than it is these days, if you can believe that. And some of the things he was looking at is growth over time. And that's why these 401ks were created. That's why that particular tax code was carved out to provide access for people to have pensions, for especially for companies that didn't have their own pension programs already built out. This was a tool, a codified tool that it was recognized by the IRS tax code for businesses to offer pension programs to their employees. And that's where the whole 401k argument started and it was all about back in the early 1970s. If you fast forward to today, we've gone through the process where a lot of companies adopted them and started using them, and a lot of companies have now stopped and are no longer allowing their use, or what is more likely the case, they're not matching them like they used to. There was a time where that some of those companies would offer as much as 15% match, and you'd be crazy not to put in all your money that you needed to do to get to that 15% match. And that's still something that from a financial planning perspective, we still pound that drum. Always take the free money. If you've got an organization that you're working with, whether it's a for profit or nonprofit or whatever, and they're offering you a 401k style retirement plan, always take the free money. Now, this is where there's some math that's involved, where maybe putting in extra makes sense. Most of the time, not. And that's what I'm going to show you here in just a second. So, using an infinite bank as an alternative to a 401k or a 403b or a traditional IRA or a self-directed IRA or any of those other IRS recognized tax deferred retirement systems, it is superior for a number of reasons. The infinite bank programs or the smart bank programs, they are superior because of one simple reason: access. So if you want to gain access to all of any of those recognized, IRS recognized tax deferred retirement programs, the problem with all of them is that you have to be a certain age to be able to access them. And when you do start accessing them, the tax bill comes due immediately. So, and that's another one of the tenet of these smart bank, infinite bank, debt-free life bank programs. So let's go ahead and I'm going to start sharing my screen and let's get into it. Okay, so there's a couple of things. Number one, the market has a correction frequently. And that correction, when it happens, it takes time to recover. So this is a timing issue. for people that are looking at retiring using their 401k as their primary reason for or their primary source for retirement. And if we look at what happened in 2008, which was the last official correction, not that little blip we saw in 2022, where the market dropped 36% and then came back 16 in the same year to the point where it was only down a net 19% and then it recovered all of it the next year. That's not a real correction, folks. That's just an oscillation. That's a shake, okay? A true correction is going to take some time to get through that whole process. So in 2008, the market dropped 33.4%. That's significant. That is, and that's actually not abnormal for when we see these market corrections. There's usually somewhere between 15 to 35% is usually the real correction. And the recovery, the average length of time is 5 years that it takes to recover. So let's say I'm 60 years old and I've got all my money invested in a 401k because my father told me to, or my grandfather told me to, or that financial advisor that I talked to 10 years ago said, yeah, just keep putting all your money in a 401k, you'll be fine. And I'm in that position, and all of a sudden that market has a 33% correction, and it takes 5 years for me to come back. And I want to retire next year. Guess what? I'm not retiring because I have to wait for the market to correct just to get back to even, which means I'm actually losing because the cost of money is about 3% per year. So if I start in 1 year, go down 33%, and it takes 5 years to come back, and now I'm back to even, I'm not. I'm still at minus 15% because of inflation. So using that second thing I just talked about a second ago, the 2022 blip, okay? That number at the time that I made this slide originally, that number was about 8.4. That's not real. There was a significant downturn that ended up being for that year. Like I said, it went down 36, came back up 16, so it's down a total of 19%. All right. So if we look at the average length of time, and I said 5 years, it looks like it's 5.78 years is what we're using in this example. I'm still going to stick with 5 years. It takes about 5 years for a true market recovery to get to where we need to be. I'm going to take some other liberties with what we're doing here, the data. The data that I'm going to use is specifically average growth for 10 years from 1998 to 2008, which was another of the big drops, was 6.18%, 187%. So if we went up 6.18% over a period of 10 years and all of a sudden we dropped 30, then we just gave back 5 years of gains. And then we're going to reset in 5 years, we get back to even, and then we're back to that same boom, bust, reset, boom, bust, reset, that same process that we go through. So let's look at this. This is an example. If you had invested money in the market and we look at a 28% tax rate, whether you're at 22, or if you're at the higher end of the scale, maybe you're at 32, or if you're at the lower end of the scale, maybe you're at the poverty level at 12%, not because you're stricken with poverty, but just because you've got your CPA who knows what they're doing and they're engineering a lower taxable income for you annually. This is what it would look like if that's where you're at. Investing in $10,000, same investment, whether you're going into an IRA or into a DFL or IBC or Smart Bank, whatever you want to call it. The DFL Smart Bank has a guaranteed rate of return. In this case, this particular program has a guaranteed rate of return of 4%. And then in the end, the DFL program, the tax-free program, outgrew that other program. And we outgrew the program, not by a little, by a lot. That's only, it's only, in this example, only roughly $2,000 better, but that's not really true because then we have to take into consideration taxes. And then finally, there's one more piece which I don't take into consideration it's not just income tax, but it's capital gains tax. And there's a huge difference between short-term versus long-term capital gains tax. How long have you had that underlying equity in your portfolio before you liquidate it or before you receive the gain? How long has it been? And that's going to be something you take up with your CPA. And if the gain was the most recent gain is what you're banking on making that money and replenishing your loss, you're going to owe a larger tax number than what I'm going to use. So this is what it looks like. The debt-free life program in this example was 16.43% better than just having the money in the market for that stretch of time. Now we're looking at taxes, and I'm using an average of 28%. So short-term capital gains taxes could be taller, plus income taxes could be taller depending on where you're at. But here's the result. The result is what you receive. It's not how much did you make, it's how much do you keep. That's really what this is all about. We're talking about retirement, okay? So in this particular example, the net yield is actually 61.7% better in the one program with the guaranteed rate of return, in this case, 4%. We didn't take into consideration a dividend. These programs typically will pay a dividend. And we didn't, this is the real S&P growth for that 10-year stretch. But what happens if we look at a different stretch of time? So here we go. What happens if we happen to call it the best time? The best time possible in the last 40 years was the run that the S&P had from 1991 to the year 2000. That 10-year run was the best. And the reason why it was the best was because you had some of these massive gain years, 95, 96, 97, all were in 98, 99. We're seeing double-digit growth years in all of those, which is phenomenal. Double-digit growth year after year, the effect of compounding, fantastic. How often do you call it perfect? How often can you call it exactly right? It's rare. And when you run into those people that tell you they can call the market right, they're usually full of it. Very, very few people can call it right. The best strategic investors on Wall Street call it right 55% of the time. And the reason why they do very well is because they call it right 55% of the time. And when they see it that they've called it wrong, they get out of their position immediately. So they minimize their loss. Most people don't have the discipline to do that. That's why most people, unfortunately, that enter the market are trading using I don't want to say gut, but they're trading and emotion is part of their trading regimen, and that is a surefire way to make a mistake. So in this example, if you got in at exactly the right time and called it exactly right one time in the last 50 years, your $10,000 investment would have turned into $40,000. After you paid the taxes on that, you would have received 28.8. In our same investment strategy with the debt-free life or infinite bank program, we would have only returned 15.9. In this particular example, and this is rare, the only example really, the investment into the S&P and IRA would have been a better choice because it's 44.8% better. Okay. So this is something that most people aren't able to do. It's very rare for people to be able to call the timing perfect. There's certainly other strategies and other possibilities that come into play here that people can choose to maybe follow that direction that the wind blows them. But this is unusual, and this is more like what the norm is. Couple things here. 1970 to 2020, there's that 50-year run. The market, S&P, went from 750 to 26,890. The average return for that 50 years is 1.9%. That's the math, folks. And unfortunately, most advisors out there are going to tout what the recent growth is, which is about 5.9%. And if you look at from 2000 to 2020, we're getting up to 3% for that stretch of time. It's still the same within that same 50 years, but now we're just focusing on a shorter run. The average return there was 3% per year. Better, but still not great. So this, in this particular case, 2.45 would be an average of that 50 years if we compare the first 50 years versus the last 20 years. And it's just a number, but here's the real number, 5.9%. If you look at the growth rate from 2000 to 2020, the average return from the S&P investment is 5.9%. Not bad. Is it better? And the answer is no. And the answer is no simply because of taxes, folks. Now, if you're investing that and you're in a Roth position, fantastic. The only problem you have is when can you touch the money? That's awesome. If you're investing in that just because you've got like a Robinhood account or something like that, and you're great, you're going to owe capital gains tax. If you're investing that in a 401k or a self-directed IRA, you're going to owe capital gains tax. You're going to owe income tax when you derive the funds from it. This is what you're really looking at. If you're getting an average growth, which is what you can hope for, a $10,000 investment over 10 years, the yield is going to yield you 17,740. It looks like you made more money than you would have that same $10,000 investment in an infinite bank or a debt-free life bank or a smart bank. But the reality is this tax number, when it rears its head, it's real. Your realized money. You put in 10 grand, you pulled out 12.7. That's not good, folks. And if you really think about it, that's really bad considering that 12.7 that you're pulling out is even further reduced by the value of money 10 years later, having 3% average inflation, devaluing the dollar every year for those 10 years. So by default, using this example with real numbers and real averages, that's the real number, 14,802. That's what you can expect with a DFL campaign. If all you do is do that level steady investment where you've got the program where a portion, whatever portion it is going into cash value, and all you're doing is maintaining. You're not doing anything to grow it. That's just the compounding growth before the dividend on these programs. You're going to yield more. Last couple things. This information is not my information. This is just research that was done using macro trends, and that's a good resource if you want to do market research. I use them a lot, especially for my clients, and it's just a tool, folks. And this is the number. The DFL program outperforms the average S&P. It's a tax-exempt program. And finally, if this happens to be in an IRA, then I have limitations on how much money I can touch and when. If I'm not old enough and I try to take it too soon, I've got big penalties. If I'm old enough, then I don't have the penalties, but I still owe the tax. No matter how you slice it, whether it's a TSP or a KEO or a SEP or a FERS program or any other kind of pension, 401k, 403b, 457, deferred comp program, whatever, no matter what you're looking at, especially if the S&P is a component of growth within those programs, an infinite bank is most likely going to be a better option for you, depending on how close you are to retirement. If you're in your 20s and you're not retiring by the time you're 40, if that's not your goal, then I'd say roll the dice. Probably an S&P is not a bad option. Some kind of IRA is not a bad option as part of your portfolio. It should not be the portfolio. It should always be diversified. So there you go. Thanks for listening. Hopefully you got something out of this. This is something that's near and dear to my heart. I'm kind of a math nerd, and I like to do the math and do those what if calculations and that kind of stuff. and it's important to know the numbers, but you never really know the numbers unless you do the math. And if you want to use that historical component, then you have to go back and you have to find a reputable source to get your numbers from. Again, macro trends. I use also, doesn't matter. I'm not going to advertise for anybody else, but that would be my recommendation. So thanks for listening. Hope you have a great day, and good luck to you. If you need help, if you have questions, reach out to us. There's our phone number and our website, forehandagency.com. You can log in and request some time, and we can set up some time to meet. Certainly, there's a phone number. Our staff is we staff the phones 24 hours a day. So if you need help, give us a call and we'll set you up with one of our advisors. Good luck to you. Bye-bye.